All right, yes, perfect. So first of all, welcome to the execution phase. How can we, the idea that we created on the analyst phase, the draw on liquidity, the bias, the narrative, how can we now capitalize on that idea? That is exactly what we are going to go over right now. So the first video that we need to go over is market structure. There's a reason why market structure right now is incorporated into the execution phase. I have had it in the analyst phase as well, and it can be beneficial in the analyst phase. And usually that is also where people use it for the analyst phase to get to a draw on liquidity, to understand where the market will go to. But I do not think this leads to great accuracy. And I do also not think that this is very beneficial, because the way I view market structure is it's quite zoomed out, right? So here, if you were to look at the monthly time frame to look at your market structure, you would do something like this. You would intermediate term low. All right. It's very far zoomed out, where market structure on a monthly time frame here, look at this. This is from years and years of price action. So market structure usually is a lot of candles. It's very zoomed out, which means market structure is something you want to be using on confirmation timeframes. Confirmation timeframes are entry pattern timeframes, where you would look for a potential entry pattern. That is on the daily time frame and below. Daily time frame is questionable, but it can be seen as for sure an entry pattern time frame. Weekly, monthly, you can use that if you potentially want to invest in some stocks or something like that, something similar to that. But overall, I do not think that majority here is going to use the monthly time frame to look at market structure, because we simply don't have years and years to look out for a trade. That's not going to happen most likely. So again, unless you're willing to invest in stocks, then you can use this on that. But other than that, it's not relevant right now. Confirmation timeframes, entry pattern timeframes are the daily and below. So that is daily, 4 hour, 1 hour, 15 minute, 5 minute, and 1 minute. So those are the timeframes that you want to use market structure on. Again, there's a reason why I state confirmation timeframes, entry pattern timeframes. Because if we are not coming off of a boundary first in the foundational levels in the top right, if we do not have a bias, a narrative, a boundary, and a target, so that context first, then market structure is not relevant. So for your daily time frame, it's only relevant if we are coming off of, for example, a monthly PD array. And then for your entry pattern, if you are looking to enter on the daily time frame, then you can look to use market structure. So market structure is always linked to the 5th foundational level, which is the entry pattern. That is where you want to use market structure. It's always looking at an entry pattern. That is very important. So the first thing we are going to go over right here is, again, the analyst phase. Because market structure is the 5th foundational level, which is entry pattern. That is where market structure becomes relevant. Well, then we first need to have a bias, a narrative, and context. All right, how can we create that again? On the monthly time frame right here, what are we doing? Well, I think the draw on liquidity is very clear. We are heading towards that premium array right there. Perfect. How can we get there? Do we have a monthly fair value gap here? No, in 26 days potentially, but I think in 26 days we have already reached that high. So let's go down a time frame to look at if we can create some context. Weekly right here. Do we have context? Well, yes, we have a fair value gap right there. That fair value gap is very low though. That fair value gap is way too low to then continue higher. And at the moment we are going to look at, we did not have the weekly fair value gap just yet. So again, let's go down a time frame. On the daily time frame, what do we see? We had this context right there. Daily fair value gap higher. That is where we can continue higher off of. So right now, this is the daily boundary. The daily context is there. That means that in that daily context, that is exactly where you are now going to use market structure. So the time frames, how you combine the time frames with the PD array, is something we are going to go over in one of the next videos. So not right now. So I'm currently going into the 1 hour time frame to look at some market structure, just for example's sake as well. So right here, if we go into the 1 hour time frame, we can understand that the daily was this. The daily was context, discount rate to that premium array. Then if we now go and define market structure lags first, what we have is we have an intermediate term high, an intermediate term low, and we have short-term lows and short-term highs. That is the only thing we are doing. And I'm going to explain you where they form, how they form, and what they look like. So the first thing we need to understand is that we have an intermediate term high. An intermediate term high is a swing high. Again, a swing high is very basic, that 3 candle pattern where you have one wick that is higher right there, then a wick to the left of it right there, and then the wick to the right of it. That creates a swing high. This is also a swing high right there. And this is also a swing high right there. And this is also a swing high right there. Those are swing highs. So an intermediate term high is a swing high, which is this high right there, that is higher. So in the middle again of a lower swing high that is to the right of it, which is sitting right there, and a lower swing high that is to the left of it, which you could take at this moment. Both these are fine right there, as long as you understand the premise that this is an intermediate term high. So this right there is now an intermediate term high. The intermediate term high is always going to be in context, meaning that if we are bearish, so we have bearish context right there, we are creating a daily fair value gap right there. Then on the 15-minute time frame and the 1-hour time frame potentially, the premium array that we are trading into, the high right there that we are creating in the context, is going to be our intermediate term high. The target is an intermediate term low right there. And that is exactly what we are seeing right now, where currently in bullish conditions, the target is always going to be an intermediate term high. It's always going to be an intermediate term high. So the intermediate term high right here is the same thing as that daily swing high that we just saw right there. That daily swing high right there. That is on the 1-hour time frame and the 15-minute time frame potentially is an intermediate term high. So the intermediate term high in this context is our target right there. That is our target. So then what is the intermediate term low? An intermediate term low is when we have, again, the same premise. We have a swing low. That swing low is surrounded by a swing low higher to the left of it and higher to the right of it. So this right here is a swing low. This swing low has a higher swing low to the left of it and a higher swing low to the to the right of it and to the left of it right there. Then this is your intermediate term low. That exact low that is sitting right there. That is what we want to use for our intermediate term low. So now we can see that we have this intermediate term low right there, and we have this intermediate term high, meaning that overall we are now trading from an intermediate term low to an intermediate term high. That's the exact same thing as context. But the reason why we go over market structure and why we use market structure right here is because this context is now created on a lower time frame. The market structure assists you in allowing you to read the lower time frame more clearly, to get a better understanding of what the lower time frame is doing. Where all this is on the higher time frame is, of course, that context, what we went over and what we hammered on so much. The context just creating that swing low to that swing high, the discount rate to the premium rate, which if you go into the entry pattern time frame, it becomes market structure. It becomes intermediate term low to an intermediate term high right there. So in between moving from this intermediate term low that we create right there, and the intermediate term low is again always created in the discount array that you are trading off of. So it's always part of context. It's linked to market structure. Without context, there is no market structure. And without market structure, again, then you have context. But we need to understand that market structure and context, they are linked. So we always need to have context first before we go into market structure. That is very important because we can also use market structure right here all over the place. And you would get probably a great indication overall on what the market wants to do, but just not that accurate. It's just not going to be super accurate, because that is where order flow comes in. That allows us to have a way better accuracy right here, because market structure wise, we could say, well, we have this intermediate term low right there. Well, we have that high. Where can we continue higher from? Well, we have this order block right there. We have a lot of lows right there. Where order flow, we would say, yes, we are likely going to continue higher off of that, which could be a 4-hour fair value gap as well right there, overlap with the highs. Perfect. That is where we're going to continue higher off of. So it allows us way more accuracy, order flow. So that is why order flow leads to the boundary, leads to the context. Then the entry pattern is where we're going to use market structure to not get lost on the lower time frame, to understand the boundaries we are working in. As in, this intermediate term low is right there, the boundary. If we come below it, then we want to take a step back. This right there is the target. If we come above it, then we want to take a step back and zoom out again. So it's to assist you to understand and read the lower time frame. Hopefully that makes sense, because that is why we use it. So this is an intermediate term low. In between moving from an intermediate term low to an intermediate term high right there, we will create short-term lows in the form of any swing low that is created after the intermediate term low right there. Short-term low right here. Then we have this short-term low. We have this short-term low right there. And we have this short-term low as well afterwards, until we reach the intermediate term high right there. That intermediate term high is then reached. Once we reach that intermediate term high, what do? We create an intermediate term range. This is now our new intermediate term range. Again, this is not super relevant. It's just understanding that this assists us right now in understanding, all right, then we know if this is the intermediate term range, we know that this intermediate term low that came into the discount array is now protected. So this intermediate term low right there is protected, because we now create that new intermediate term range higher, which again is just simply on the daily, on the boundary PD array, on the boundary time frame, is just that swing low created to continue higher to create a new fair value gap, which creates, again, just that new order flow lag higher. So that is your daily, in this case, would be your boundary. As in, if you were to look for a PD array to trade off of, you would refer to the daily here. If you are then, again, looking for your entry pattern time frame, that is when you go into the 1 hour. So, meaning that you would first wait again for a new context on the time frame above it, to then go into the 1 hour right there, to then look for your new market structure potentially on the lower time frame again. That is very important, and that is how we combine market structure. As in, that is where we use it. That is quite important to understand first, because otherwise we are going to be all over the place with our market structure. Now, I just mentioned intermediate term range. Then what are the short-term ranges? Short-term ranges are the exact same thing as order flow lags. So a short-term range is the exact same thing as an order flow lag. An order flow lag is a short-term range. So in between, and this is what we'll touch on in the next video, a little bit more order flow, is that in between from that intermediate term low towards that intermediate term high, we are creating short-term lows. Those short-term lows are short-term ranges if they have a fair value gap in it. That fair value gap allows us to have a short-term range, which just is, again, it's just an order flow lag higher right there. So every swing low that is responsible for creating a new fair value gap higher is a short-term range. So the short-term range here is this right there. That creates the short-term range higher, which is, again, that order flow lag higher. Now, understanding the next part is that how do we then confirm? How do we go over the fact that this is an intermediate term high? An intermediate term high is, an intermediate term low is a sharp turn. That is the same for an intermediate term high, etc. It's just vice versa. every time we come into a PD array, so we come into that boundary that we want to look for our entry pattern on. So the entry pattern here we want to look at is on the 1 hour time frame. Then this entry pattern right here is where you would want to see a sharp turn. So the intermediate term low that is created right there is the low of a sharp turn. What is that ST? What is that sharp turn? That is what we're going to go over on tomorrow. So don't worry, that's going to be a separate video. It's just understanding, so you can write that down and you can clarify it with a different video later on, is that the sharp turn right there is the same as an intermediate term low. So the low of a sharp turn is an intermediate term low. The high of an intermediate term high is the high of a sharp turn as well. That is important to understand. So how do we confirm an intermediate term low? An intermediate term low is confirmed once order flow is confirmed on the respective time frame. The respective time frame and which time frames you would use is, again, understanding the time frames first in combination with one another. So this is where a separate video also needs to come in. But on the 1 hour time frame, an intermediate term low is confirmed right there once we have a 1 hour fair value gap higher right there. That is if we are using the combination of a daily fair value gap and a 1 hour entry pattern. So for confirming your intermediate term low, I'm going to give you the time frames right now for confirming your intermediate term lows with only a sharp turn. So with only one sharp turn, which means that we only need one fair value gap higher, basically. This fair value gap higher right there. So to confirm a sharp turn with one fair value gap higher, nothing more to it, just a fair value gap higher out of the PD array that you're trying to confirm. The intermediate term low that gets created right there is when we have on the monthly time frame, you would use the daily. So the daily entry pattern, the daily sharp turn that gets created, that creates a fair value gap higher right there, is going to be your intermediate term low, the low of that sharp turn. Then for the weekly, if you're using a weekly PD array, it would be the 4 hour. For the daily, it would be the 1 hour. For the 4 hour, it would be the 15 minute. For the 1 hour, it would be the 5 minute right there. 15 minutes, is likely going to be the 5 minutes as well. So that is how you would use it. Sorry, 15 minutes is actually the 1 minute. Excuse me. 15 minutes would be the 1 minute right there. So that is when we have a sharp turn. That sharp turn is the intermediate term low. That is how we view it. Even though we might not have our swing low higher to the right of it at that moment in time. That is, at that moment in time, again, not relevant because that is where we are going into the lower time frame even to confirm the intermediate term low, etc., which is, again, a next video that we need to touch on as well. So right here, we have this intermediate term low. That intermediate term low is, again, confirmed by this fair value gap higher. So we can also, and I can understand if you think, all right, but this swing low was responsible for the fair value gap higher. So is that swing low not the intermediate term low? No, that swing low is not the intermediate term low. That is always going to be a short term low. The reason for that is just simply is the lowest low that had a sting into the PD array that you are going to trade off of. That's the same with if we turn it into a bearish factor, then from a bearish standpoint, the premium rate, so the highest high inside the premium array that creates the ST, that will be responsible and that will be the intermediate term high. So this right there is the intermediate term low always at that moment in time. So then the next part is that we understand, all right, here, what can we do? Well, here we can now go and look at our entry pattern potentially, because that in itself is already an entry right there. Then why does this short-term low right there not hold? Because that short-term low has a 4-hour fair value gap below it right there. So that is what you need to take into account right there, that we eventually are going to continue higher off of that. Which if we dive into the 15-minute, then this right there is now our intermediate term low right there on the 15-minute basis. Again, not super relevant right now, but that would then be your new intermediate term low to your new intermediate term high in the form of this high right there, which is again that 4-hour context that we're just trading off of. So then eventually we also need to understand how we can use this even more so on the lower time frame, which is again what we are going to go over right now. But before we do that, we need to understand again that the intermediate term low is always the context low, and the intermediate term high is always the context high right there in the form of your target. The intermediate term low gets created at the boundary. If you have bullish context, that means that the target is an intermediate term high right there. That is very important to understand first. Then the next thing is, again, what we mentioned is that we now are going to go into the lower time frame again. So let's go over Euro US dollar, because if we take a look at this live example right here, then we can see on the monthly time frame we had what? On the monthly time frame, we are looking to continue higher overall potentially. So we have this previous month's high as a target. This is what we went over in the previous video as well. That is our target right there. So if that is our target, do we have context on the monthly? Not yet. So on the weekly, we can see, yes, we have weekly context potentially right there. So if we are going higher, we can continue higher off this weekly Verweij gap to target that weekly high as well. That is very interesting. So right now, we again have the same thing, as in we have a boundary right there to look at our entry pattern. That entry pattern is now where market structure comes in. So if we go into the 4-hour, because we mentioned weekly PDRA, 4-hour, if the 4-hour creates a sharp turn right there, then that would be our intermediate term low. So this right there, if this creates a Verweij gap higher on the 4-hour time frame next week, then this right there is going to be our intermediate term low. That is where we would not expect price to come back below. If that does happen, that of course invalidates the ID. That is suspicious. That is not something we would want to see. So, but we can also see that the intermediate term low right here is not there yet. This is where we are now going to go into a time frame below it, because we can also understand that we have monthly was the daily time frame, right? That is if you only need a sharp turn. So let me define that very clearly right there. This might not make sense in the beginning fully. This is also where the next videos are going to come in as well. Monthly PDRA that you want to confirm. So that monthly boundary, that monthly context is where you're going to use as your entry pattern or as a next confirmation to go into the daily to look at your 1 hour, for example. The monthly PDRA is where you use the daily ST as a confirmation. Or you're going to use the 4-hour ST plus a RE. Now, to understand RE, we need order flow, which is again what we're going to go over the next video. This is how you would confirm a monthly PDRA. That is for your entry pattern again. Then for the weekly PDRA right there, you would use a 4-hour ST, or you would use a 1-hour ST plus a RE right there. For your daily PDRA, you would use a 1-hour ST, which is the example we went over on gold, or you would use a 15-minute ST plus a RE right there. Then a 4-hour PDRA is where you would use a 15-minute ST or a 5-minute ST plus a RE. So the 1-hour PDRA is where you would now use the 5-minute ST or the 1-minute ST plus RE. And the 15-minute can have both a 1-minute ST or a 1-minute ST plus RE, depending on the situation. Depending on the situation, it's also things we are going to go over. It is important to understand right here why we do this and why the ST is an intermediate term low already. It's because when you are confirming a monthly PDRA right there, you are basically looking at a daily ST or a 4-hour ST plus a RE. A 4-hour ST plus a RE, you can probably already tell, that is more confirmation. So on the 4-hour, you need more confirmation than on the daily. Because, very simply, very easily as well, is that the daily is the higher time frame. So the daily has already more candles inside of it. in that daily candle, there is 6 4-hour candles. So if we have a daily ST, then we likely already have a 4-hour ST plus RE. If we have a weekly PDRA right there, and we create a 4-hour ST, then we likely already have a 1-hour ST plus a RE. That is the same for the daily, that is the same for the 4-hour, it's the same for the 1-hour right there. So the 1-hour ST on the daily time frame is, the 1-hour ST on a daily of a daily PDRA is where we likely already have a 15-minute ST in plus RE inside that 1-hour ST. Now, what does that look like? Because right here, we can see that we are creating potentially a 1-hour ST here. Well, we have a 1-hour ST. Again, ST, how does it look like? We're going to go into detail on that as well. The ST, very simply said, is displacement in, displacement out. Verwijder gap into the PDRA, verwijder gap out of the PDRA. More details is exactly what we need to go over in the order flow video. Then right there, we can also understand that we create that verwijder gap. Once we create a new fair value gap higher off of that on the 1-hour time frame, that creates a RE. So then we have an ST plus a RE. That RE right there is what would allow you to enter on the 1-hour time frame of a weekly PDRA. So that is the 1-hour ST plus the RE, which means that if we get a fair value gap higher right there on the 1-hour, we likely also do what? We likely also create a 4-hour ST in the meantime. So the 4-hour ST is basically the same as a 1-hour ST plus a RE, which means if we create a 4-hour ST right there, then this is the intermediate term low. If we create a 1-hour ST plus a RE, then this is also the intermediate term low because they are the same thing. Again, sometimes you will have that we don't have an ST plus RE or that we don't have an ST on the time frame, etc. Perfectly fine. That is perfectly fine. You don't need both. You only need one of them. So you only need one of them right there. You don't necessarily need both. So if you're waiting for a 1-hour ST plus RE, because that is your entry pattern, then you don't need a 4-hour ST to happen. Doesn't work like that. You don't need it. So that is exactly how you would go over it. And that is understanding why this is an intermediate term low on the 4-hour, why this is an intermediate term low on the 1-hour right there. That is where the sharp turn, etc. eventually comes in. So right here, we are creating potentially an intermediate term low because this is not an intermediate term low just yet. Why not? Because we have not created a RE right there just yet. What exactly is a RE is again what we are also going to go over in the next video. But right there, that is not an intermediate term low just yet because we have not created that new fair value gap higher right there of the previous ST. That is important to understand. So eventually, if we do that and we create that, then this is the intermediate term low. That is now the protected low. You would not expect that one to get swept or to get taken or anything to get traded below. And this high right there is what? That is an intermediate term high again. So this creates our context. This creates our guide, our navigation on the 1-hour time frame right there to understand what price might want to do. So a new intermediate term low can only be created once we take out the context right there. Once there's no context anymore, that is when we can create a new intermediate term low right there to then eventually continue higher. This is the basis of market structure. And again, I can understand if this is quite difficult to comprehend because it is a pretty difficult concept in itself because you need to know where to use it, how to use it, etc. All those things. So right here, we need the next step, which is order flow, which will again will help us in understanding market structure a little bit better. So the next video on order flow is also where we're going to go over again that market structure. So this is the very basics of market structure. The very basics of market structure, the first thing that we need to understand before we actually look to enter. All right, then I'll see you at the next video on order flow. Perfect. Thank you.